Hey guys, this is Riado and welcome back to this channel. If you haven't done so, I encourage you to watch part 1 of my Alibaba stock analysis as it will give you the proper context for this video. With that said, you can find the link to part 1 in the description below, and with that out of the way, let's continue with part 2 of the analysis. Turning to the company's profitability metrics, we can see how gross profit has trended over the last few quarters. In 2023, gross profit was 319 billion yuan or 46 billion US dollars, which represents a 37% gross margin. In Q4, gross profit was 69 billion yuan or 10 billion US dollars, which is a 33% gross margin. And as you can see, gross margins has been trending downwards in the last few quarters, but Q4's gross margin of 33% is still an improvement from last year's 32%. Nonetheless, the declining gross margins over the years is not a good look overall. Operating margins also seem to be under pressure, and in 2023, operating profit was 100 billion yen or 15 billion US dollars, which is a 12% operating margin. Last year, operating margin was just 8% in 2022, and the year-over-year improvement is actually due to a higher impairment of goodwill recorded in 2022 related to the digital media and entertainment segment in 2022. On the other hand, Q4 operating profit was 15 billion yuan or 2 billion US dollars, which is a 7% operating margin, and the drop in operating margin in Q4 that you see right here was due to higher share-based compensation, where it was negative in Q4 last year and it returned to positive again in Q4 this year due to the mark-to-market adjustment of Ant Group share-based awards. So excluding this adjustment, operating margin would have expanded around 500 basis points, driven by operating leverage across the entire business, so that is good to hear. Moving on, net income for the year was 66 billion yuan or 10 billion US dollars, which is an 8% net income margin, and in Q4 it was 22 billion yuan or 3 billion US dollars, which is an 11% net income margin. And as you can see, net income margins have been very volatile over the last few quarters due to a variety of reasons, and this includes changes in the market value of Alibaba's equity investments in publicly traded companies, as well as fluctuations in currency exchange rates. So given the volatility in net margins, I don't think it's helpful to look at this metric. Instead, we can take a look at Alibaba's non-GAAP metrics provided by the company, which excludes non-cash items like share-based compensation, changes in the fair value of its equity investments, as well as goodwill impairment. At a quick glance, we can see that all non-GAAP metrics are all in the green over the past 3 years, but we can also see that profitability peaked in 2021 and then dropped in 2022 and slightly improved in 2023, although they never reached the same levels that we saw in 2021. So the company mentioned that the improved profitability year over year was due to higher China commerce profitability, as well as lower losses from the local consumer services and digital media and entertainment segments. That said, in 2023, non-GAAP net income was 141 billion yuan, which is a 16% margin. Adjusted EBITDA was 176 billion yuan, which is a 20% margin, and adjusted EBITDA is about 148 billion yuan, which is a 17% margin. And as you can see, Q4 margins all improved year over year as compared to the same quarter last year, which shows operating leverage within the Alibaba ecosystem. Here you can see adjusted EBITDA margins by segment, and as you can tell, China commerce segment is the most profitable segment as it is actually the cash cow that is supporting the other 6 business segments. However, you can see that profitability in each of the 7 business segments are improving, a good sign that things are trending in the right direction as the company displays improving unit economics, operating efficiency, and disciplined control of costs. So while the top line growth has been pretty underwhelming, which only came in at 2% year-over-year growth rate in 2023, margins are all improving year over year, which tells me that Alibaba as a conglomerate can achieve economies of scale and operating leverage. The China commerce segment remains the cash cow in the Alibaba ecosystem, but I do expect some of the other segments to turn profitable soon as well. I think there's more opportunity for Alibaba to improve profitability down the road and create better shareholder value, especially when the company spins off its business units, which should lead to higher operating efficiency at the segment level and ultimately better profitability overall. Turning to the balance sheet, Alibaba has has a strong balance sheet with about $76 billion of cash and short-term investments, and the company also has a very manageable total debt of $28 billion. So that put its net cash position to be about $48 billion. Current ratio is also at about 1.8 times, so its balance sheet looks pretty healthy to me. At the same time, Alibaba is also a cash flow machine. In 2023, the company generated 172 billion yuan of free cash flow, or $25 billion US dollars, which represents a 20% free cash flow margin. In Q4, Alibaba generated 32 billion yuan or $5 billion US dollars of free cash flow at a free cash flow margin of 15%. So the year-over-year improvement in free cash flow margin from negative 7% to 15% this year was due to better profitability as discussed earlier, lower capital expenditures, as well as anti-monopoly fines that were recorded in Q4 last year but did not happen this year. With all that free cash flow generated, Alibaba allocated a good portion of them for share buybacks. Alibaba bought back roughly $10.9 billion worth of stock in 2023 alone, on top of about $9.7 billion in 2022. As of Q4, Alibaba still has $19.4 billion remaining under its share repurchase program, so I expect more buybacks to come as long as Alibaba shares remain under pressure. Turning to the outlook, Alibaba doesn't give any form of guidance, so we don't know what to expect in terms of financial performance, but we can definitely expect more growth from the company. As you can see, before the announcement of the reorganization plan, Alibaba aims to serve more than 1 billion consumers in China by the end of 2024 and 2 billion global consumers by 2036. And keep in mind that Alibaba already has 1 billion annual active consumers in China, so that means the company is prioritizing global expansion as part of its growth strategy. As of the end of 2022, Alibaba has 1.3 billion global consumers, so achieving 2 billion consumers by 2036 will be a big milestone for them. And of course, the company is already making steps to achieve that goal by announcing its intent to expand to Europe. So moving forward, I expect more global expansion initiatives from Alibaba. And of course, we can't talk about the outlook of the company without talking about the company's restructuring plan. So on March this year, Alibaba announced the restructuring plan to break up its ecosystem into 6 separate business units, which will be the Taobao Tmall Business Group, Global Digital Business Group, Cloud Intelligence Group, China Smart Logistics, Local Services Group, and Digital Media and Entertainment Group. Each business unit will have its own CEO, and under this new structure, Alibaba Group will become the holding company of these 6 business units. But do note that Taobao Tmall Business Group will remain wholly owned by Alibaba Group, while the rest of the business units will be spun off. In fact, they are already in the process of being broken up. For instance, the Cloud Intelligence Group is expected to be separated in the next 12 months and become an independently publicly listed company. China Smart Logistics, which Alibaba Group owns a 67% equity stake in, is also exploring to IPO in the next 12 to 18 months. And Fresh Hippo, which is under Alibaba's China commerce segment, is also expected to IPO within the next 6 to 12 months. That said, we can expect lots of changes and developments over the next year or so as Alibaba undergoes restructuring. The rationale behind the restructuring is that individually, the business segments will become more agile, have more freedom to execute its strategies, and have better flexibility in terms of raising external capital. This way, Alibaba as a holding company can promote decentralization and autonomy across its business units. Furthermore, through this restructuring, Alibaba will no longer be perceived as a monopolistic business, and this should significantly reduce regulatory risks with the Chinese government. As a result, the business units will have more time, money, and resources to grow their respective businesses with minimal regulatory pressures, which has the potential to unlock shareholder value. And one last note, profitability is already improving over the last few quarters, and this restructuring should accelerate that improvement, which should unlock greater shareholder value through higher earnings potential and higher profitability. With that said, some investors argue that Alibaba should be valued much higher than it is today. As you know, Alibaba shares peaked at about $300 per share in late 2020 and then crashed 80% all the way down to $60 a share due to geopolitical tensions with the United States, including a potential delisting from the New York Stock Exchange, as well as regulatory pressures from the Chinese government, including anti-monopoly violations and the failed Ant Group IPO, which Alibaba owns a 33% stake in the company. However, now that Alibaba is reorganizing, I think it will get both US and Chinese regulators off Alibaba's back. At the same time, the business separation should unlock shareholder value through better operational efficiency without the inertia and bureaucracy that comes from a conglomerate. But even with the positive news, Alibaba stock barely rallied with the broader markets and is now underperforming the indexes. But the question is Alibaba stock still a buy at $92 a share? Let's find out. If we take a look at Alibaba's valuation multiples, we can see that Alibaba is valued very cheaply based on historical standards. As you can see, Alibaba trades at just 7 times its free cash flow and just 1.6 times its sales, which is the cheapest they have ever been ever since the company went public a decade ago. To put that into perspective, if Alibaba returned to a free cash flow multiple of just 20 times, which I think is perfectly reasonable, Alibaba stock could surge 150% plus. So without doubt, Alibaba is very cheap when we look at its past multiples. But moving on, let's see what analysts are saying about Alibaba stock. So here on Seeking Alpha, we can see that Wall Street has a strong buy rating on Alibaba stock with 34 strong buy recommendations, 8 buys and 3 holds with no sell recommendations at all. And if we scroll down here, we can see that the price target set by analysts is about $139 per share, which represents a 51% upside from current prices. Analyst also has a low of $93 per share today, which is pretty much what the current prices is, and also has a high of $178 per share, which represents almost a double in price. So overall, Wall Street is very bullish on Alibaba stock. So here I also did a DCF model on Alibaba, and this is based on the assumption that Alibaba does not go forward with the restructuring plan. In other words, I'm trying to find Alibaba's intrinsic value if Alibaba's ecosystem remains intact as a single unit. So again, this is my DCF model and these are my key assumptions. For revenue growth rates, I followed analyst estimates for the first 3 years and I just plugged that in right here, and then I'm gonna just gradually drop it down to 5% year-over-year growth rate in 2033. For cost of revenue, it seems like cost of revenue has been trending upwards over the last few years, probably due to product mix. So I'm going to keep cost of revenue at about 65% of revenue for all the years, which means a 35% gross margin. As for operating expenses, it looks like the company is gaining operating leverage as operating expenses as a percentage of revenue continues to drop year by year. That said, I'm going to extrapolate that trend further, with operating expenses dropping from 24.5% in 2024 and then reaching 23.2% by 2033. For income tax, I'm going to keep the effective income tax rate at 25%. And for depreciation and amortization, it seems that it's trending down as well, so I'm going to set it at 4.5% and gradually drop it down to 4%. And for stock-based compensation, capital expenditures, and changes in net working capital, I'm going to set them at a constant rate of 3%, -4%, and -4% of revenue respectively. So based on these assumptions, I have Alibaba achieving a $252 billion revenue at a free cash flow margin of 15.9% by 2033. And as a reminder, Alibaba has a free cash flow margin of 20% in fiscal year 2023, so my free cash flow assumption for Alibaba is actually quite bearish. And so based on a perpetual growth rate of 2% and a discount rate of 10%, I arrive at an intrinsic value per share of $165 per share for Alibaba stock. And with the current price of $92 per share, that represents an upside potential of about 79% for investors today. And as you can see, my fair value estimate is higher than the average analyst price target of about $140 per share. And of course, this is my DCF model and my assumptions may not be correct, so don't forget to do your own due diligence. But that aside, I think Alibaba stock is very undervalued compared to its intrinsic value of $164 per share. On a side note, the FUD behind Alibaba stock is extreme as institutions have been selling Alibaba over the last few quarters, as you can see right here. Nobody knows how the political landscape will unfold between Alibaba, the Chinese government, and the US, which is probably why institutions are dumping shares of Alibaba. But there are several super investors that are bullish on Alibaba stock. The most widely known will be Charlie Munger, who has Alibaba accounting 90% of his portfolio. Although Munger cut his Alibaba stake by half a year ago, a 19% position is still very large, which is still a good sign that he sees some value in Alibaba stock. I mean, he has only 4 stocks in his portfolio, so that shows how much conviction he has on Alibaba. In addition, Michael Burry, the Big Short guy, has 9% of his fund in Alibaba stock, and Michael Burry is an extreme contrarian, so him buying Alibaba stock could be a very bullish signal. Whatever it is a great sign to see some super investors buying Alibaba, which should give some boost of confidence for investors. But do note that with investing in Alibaba, you're basically betting on geopolitical resolution between China and the US, as well as Alibaba's improving relationship with the Chinese government, which is pretty much unpredictable. But I think the worst has passed for Alibaba, which is why I started a small position in Alibaba stock at $92 per share, as I think the stock is severely undervalued. I also think that there are some catalysts that could push the stock to the upside, including the official IPO announcement of Alibaba Cloud and Cainiao, which is going to happen in the next 12 months, which I think is going to bring some excitement into the markets. Before I end the video, let's quickly talk about the risks with investing in Alibaba stock. The first major risk is that even despite Alibaba restructuring, we could see additional regulatory attacks from the Chinese government, which could tank the stock. Anything can happen in China, and we could see tightening of regulation of monopoly and unfair competition, which could limit Alibaba's growth. For example, Alibaba Cloud is the largest cloud provider in China, and that means Alibaba Cloud could be a potential target for Chinese regulators. The next major risk is rising geopolitical tension. Changes in international trade and investment policies due to poor US-China relations could also hinder Alibaba's growth. If things get worse, Alibaba could also face delisting risks, which could lead to forced selling. So I haven't mentioned this, but Alibaba stock is very much politically driven rather than fundamentally driven, and investing in something politically driven is very unpredictable in my opinion. But again, I think the worst has passed for Alibaba. Another risk to consider is a potential spin-off or IPO delay, or maybe an outright rejection by Chinese regulators. I think the performance of Alibaba stock largely depends on the successful execution of its restructuring plan. So if we see any delays in the process, the stock will trade sideways, or worse, investors may give up hope and Alibaba's valuation could re-rate lower. And last but not least, we have competition. The competitive landscape in China is very fierce. There's WeChat, which is owned by Tencent, Baidu, Pinduoduo, JD.com, Meituan, and more. Alibaba also faces stiff competition in Southeast Asia, which includes Sea Limited's Shopee, Singapore's Grab, and Indonesia's Gojek and Tokopedia. Not only that, but Alibaba Cloud also faces extreme competition of its own. As you can see, AWS, Azure, and Google Cloud owns about 65% of the cloud market. As such, Alibaba's cloud growth, especially international growth, could be limited because of the big three dominating the cloud industry. So to wrap up this video, Alibaba is certainly a battleground stock that is highly volatile, but I see significant upside for Alibaba stock given the recent positive developments, including the restructuring plan. And despite the good news, Alibaba stock is still trading at depressed levels, which presents a great opportunity for investors to accumulate shares today. But do understand the risks. The stock is politically driven, and any attacks from the government, which could happen at any time, could pretty much wipe out your entire investment. So I think it's a great idea to keep position sizes small. That said, I think it's quite rare to see a high quality company with strong competitive advantages trading at a massive discount. And I think Alibaba fits the description, which is why I'm taking advantage of the fear and buying the stock. Well, that's it for today's video, guys. Please let me know in the comment section below what you think about Alibaba stock. And of course, if there's any stock that you want me to cover in this channel, please let me know as well. As always, thank you for watching this video. I appreciate you and I hope you have an amazing day. See you guys on the next one.